We did talk a little bit in the video about sector rotation and first 2 week study. I'll say I'm actually a bit surprised when I pulled up this data set. I did not think that we were going to see a data set that looked like this. I thought that we were much further along the cycle. But according to this data set, actually, we're still right up here, which means that the Fed still has lots of room to raise interest rates. And I had mentioned right at the end of the video that we have been looking at things like retail sales. The Johnson Red Book came out, and that's a pretty good sort of measure of consumer strength. And I think the consumer in the United States is actually very strong. And how ironic! This was probably the biggest concern for me here, because we would like to see the Fed stop raising interest rates, and we get back to sort of a happy-go-lucky kind of market state. But as long as the retail sales are this strong, I can't see how the Fed can stop raising interest rates. And I had told you guys that this thing should sort of flatline right around, say, 2-3%, kind of like what you saw through here. This is a nice, healthy, happy environment, low inflation. Then we start getting ramping up, and you got to get concerned. And then, of course, we went into the sickness nonsense. And the central planners, for lack of a better term, they completely dropped the ball. And we had, guys like Druckenmiller saying, "Why are you doing this to us? It makes no sense. You completely destroyed the purchasing power of our currency. Thank you very much, you stupid jerks." Anyway, so we still are in the process of unwinding this. And like I said, big uptick here, back close to 10%. That's too hot. So I thought that was interesting. And we look at the data, and the data actually says that, the Fed could continue rising interest rates. Now, the interesting thing to this is that the yield curve is already flat to inverting. So I guess what you'd say is we're sort of somewhere in here. And, how bad does bad have to get? Because the bonds actually look like they're firming up quite a bit. Mind you, I think I did see the bonds actually starting to roll over a little bit. We've talked lots about this, and I mentioned this in the last video, that really, when is the Fed going to stop raising interest rates, and when are we going to go back to a happy-go-lucky market? When are we to expect that the Fed should stop raising interest rates, and that we should start going back into a friendly interest rate environment, friendly risk-taking environment? Our TED spread is now called the Fed spread, is this teal line, and it's a pretty good barometer reading of sort of the health of the financial system. Readings above 100 here, this is, hey, we got major problems. And you better start raising interest rates in earnest to bring this relationship back in line. Ideally, here is the 2008 financial crisis. What do you think? Did that go above 100? So you can see, and here is the dot-com bust, right? The war on terror and all that nonsense. And see that above 100. So you can see, we are having our recessionary interest rate crisis right now. This is usually what happens in these cycles. But once every 10 years, the rule is that recessions usually happen in years that end in zeros, or, eights, nines, zeros, ones, and twos. So what a surprise. There's a one, and of course that was the dot-com bust. This was the U.S. financial crisis. Of course, there's, 8, 9. So that makes sense. And here we are this cycle. And of course, like we said, because of the sickness, everything got sort of pushed back a couple years. And sadly, they actually made things a lot worse than they really had to be. But that's a conversation about what's the bankster's actual strategic plan here, I suppose, is the best way to describe this. Anyway, so the point of the matter here is, if we want to, when do we expect to see interest rates bottom? This orange line is the market-based proxy for short-term interest rates. And really, you'd like to see this put in a nice wide weekly W here. You can see we are flirting against previous lows. And as we had mentioned in recent videos, we are heading into an inflationary, dangerous part of this seasonal cycle, because energy prices are heading into a seasonally friendly period. And if energy prices start ratcheting back up here through the winter and the late, early spring, that will definitely cause interest rate proxies to start freaking out again. So we're not here yet. And then if we actually look at these long-term cycles, you can see based on this sine wave that actually this short-term interest rate policy moves in very predictable 4-year patterns, where, we just had a bottom in rates, and we're going through the rising interest rate environment, and that should not pivot until midsummer, somewhere in there. So probably have another 6 months of this ahead of us. And interestingly enough, based on the data coming from the stock market, this would still suggest that the Fed could continue raising rates. And according to our money cycle, you should expect that for the next 6 months or so.